Hello guys, stevenduxi here. Since the market is being really slow, it's time to follow up on your own statistics tracking sheets. And today I will be introducing about two different methods of how to really track and use your own statistics. I've been getting a lot of questions, Steven. Well, I track a lot of statistics, but I don't really know how to use them, to benefit for my actual trading. So today there will be two methods. Before I start this video, make sure to click the like button and subscribe. It's going to really help our YouTube channel to give you now more free content. So hit that like button and let's get started. First thing you want to do is you want to get a solid winning percentage on one pattern. You need an average about 100 to 150 samples to be able to support your theory. Second thing you want to do will be the frequency of the pattern. You want to track how many times happens per year so you can get an idea of, okay, this is about a pattern that can happen around 70 to 80 times per year. The third thing will be the reward. That fully depends on your own entry and your own exit to get the average reward each time when you trade it. So the third thing I want to talk about will be the reward. Now, when you are entering into a stock and exit into a stock each time, you will be able to generate the average reward. Once you find that, then you will know, okay, so first red day average reward will be 15% in the first half an hour or in the first an hour. Then after 10, you will slowly reduce its own reward. By tracking that, you will be able to find the right time to exit your stocks and the right time to enter the stock. So be able to track the winning percentage, the frequency of the pattern, and the reward of the pattern. You will be able to generate a simulation of how much money you can make per year. In that way, when you are live trading, you won't be too nervous about it because you have a massive database to back you up, to give you more confidence when you are actually placing a trade. So the second method I want to talk about, which is the main point I want to cover, is how to really separate a pattern into multiple different sections to be able to generate the better entry and better winning percentage. And that's something that's going to be a little bit difficult to understand, but let me give you this concept first. So when you have a small account and you want to grow your account in this day trading industry, when you are looking at the market, you want to look at the market in different perspective. So let's assume the average dollar can be traded in a day of all day traders add together will be 500 million. And let's also assume the maximum dollar can be traded of all day traders add together will be 1.5 billion. So the average 500 million, the maximum 1.5 billion. So to be able to generate a high reward strategy, you need to focus on the market caps that is under 100 million. 500 million dollar can make 100 million stocks spike 500%, but 500 million can only make $10 billion stocks spike only 5%. When you are tracking your own pattern, you want to split them into different market cap sections. 0 to 100 million will be one section, 100 to 200 million will be another section, 200 to 300 will be another one. And each pattern is supposed to have about anywhere between 3 to 5 sections or even more. So let me give you an example. Overextend gap down is a very famous pattern. But when I track statistics, if the market cap exceeds 500 million, overextended gap down pattern does not work that well. That is very important for you to track specific market cap zones to be able to select, okay, so if the market cap exceeds at this point, the pattern will not work. Because the pattern is specifically designed for back orders, amount of volumes being traded, and how much market cap there is. Once you can filter out all of the unnecessary criteria, and you should have a much better winning percentage in terms of trading this one pattern. And the last thing I want to talk about is level 2. To be able to read level 2, that takes a lot of market experience. It's something that's hard to explain because when you are looking at level 2s, different market caps offers different level 2s. Let me give you an example. So 10,000 shares is a lot if the flow is only 1 million. Now 10,000 shares is nothing if the flow is over 100 million. So to be able to read in different market cap zones, that takes a lot of market experience for you to trade one pattern for at least 100 times. Then you should be able to have some type of idea of, for 1 million flow, 50,000 shares is a lot. Then for 100 million flow, 10 million shares in one order, that's a lot. And that's something takes a lot of screen time, but at the beginning, level 2 doesn't really matter. When you know about level 2, that can potentially give you a better entry and exit. And level 2 will not affect the overall picture in terms of reward So just be patient and try to read level 2s or record the level 2s to be able to review it each time if you don't understand something. And that will be all of the 3 things I want to talk about today. And hopefully it's helpful, and make sure to leave a comment below if you have any questions. And the market is fairly slow for now, so make sure to track your own statistics. Remember, the longer you trade, the better you are. So that will be the end of this video. Thank you very much for watching, and I will see you guys next time.